The next thing which we'll look at is the foreign exchange risk, especially when international transactions are involved. And how do you really get into a hedging position for the foreign exchange kind of a risk? See, typically, whenever we talk about the forex risk, the first thing that comes out for us is identifying the exposure. Exposure is nothing but long versus short, or how much assets we have in a foreign currency versus how much liabilities we have in the foreign currency. Assets are nothing but how many loans you have given from a bank perspective, how many loans they have given for the foreign customers is their asset, how much borrowings they have done, or probably if I look at a typical Indian bank, how much loans they have given to US customers is their asset portfolio. US asset, USD based assets. How much borrowings they have done in USD, their USD based liabilities. So in a particular foreign currency, I'll find out for any person, even for us, right? If I talk about how much investments I have in dollars, investments could be in the real estate there, or could be in the stock markets there, could be the bonds there, whatever, dollar denominated. In dollar denominated, how much of assets I have, and in dollar denominated, how much of liabilities I have, which are borrowings, right? So the net of these two is what we call as exposure for that particular currency, right? So probably if I have properties and all worth $50 million, right? But I have taken the loan in the US market alone. In the US market alone, let's say I have taken a $45 million loan. What I can very well see is I have an exposure of $5 million, which is as good as I have borrowed 45 million in the US market and invested somewhere, which right now has become around 50 million. So my exposure is 5 million positive. That is what we simply call as an exposure. So when we say we are positive, net is we are long in a currency, because I have more in terms of dollars. Dollar assets are more than dollar liabilities for me. That is what we call as we are net long in a currency. The positive is a reflection of being net long in a currency where assets are greater than the liabilities in that particular currency. Now, what is the risk for us? If the foreign currency appreciates, $1 becomes 66 or 67, we are very happy, right? Because my assets are more, my dollar denominated assets are more compared to the dollar denominated liabilities. As a Indian rupee hold, if my domestic currency is Indian rupee, my dollar denominated assets will be more than my liabilities, which means if the dollar appreciates and rupee depreciates, my profit is increasing, right? Because $1 becomes 67, 68. So probably I have $5 million benefit. $5 million into 68 rupees, 70 rupees, 80 rupees will what is the benefit which I am going to receive. So when I am having a net positive exposure, the foreign currency appreciation and domestic currency depreciation will actually benefit me to the largest extent. Whereas my risk is the other side. If the foreign currency depreciates, I'm actually getting into a loss, right? The same is the opposite if my exposure is net negative. My assets are $45 million, my liabilities are $50 million. So my net is minus $5 million. So if I translate it again to the Indian, if my rupee appreciates or if the dollar appreciates, I'm losing very, very heavily. My loss is increasing. Whereas if the rupee appreciates, probably my loss is decreasing. So first thing we have to understand is for each of the foreign currencies, the way I have to look at the foreign exchange risk is, for each of the foreign currencies, am I net long on it or net short on it? Right? Net long means probably foreign currency appreciation is more beneficial to me, domestic currency depreciation is more beneficial to me. The risk is the other side. But if I am net short on any currency, we have to do this exercise for each and every currency where we have either borrowings or lendings, right? Investments or borrowing. So here, in this case, if we are net short in a particular currency, obviously the domestic appreciation is good, foreign depreciation is good. But as a risk, right, we are not talking about profitabilities and all here. We are more of a risk management professional. So the intention is to reduce the risk. Both of them are risky only. In both cases, on one side there is a profit, the other side there is a possibility of a loss. So in both cases there is a possibility of a risk. So our intention is always to mitigate that risk altogether by doing some kind of mechanism. The hedging strategy will look at it. But by getting into some kind of a mechanism, our intention is to reduce our total exposure. Now, where all the forex risk can come, one, your assets are more than the liabilities in the foreign currency, or look at your purchases. See, this year you have purchased more in foreign currency, which is again adding up as an asset. I mean, if you literally translate it into the balance sheet language, any purchases you are making, if they are a long term kind of purchases, they are as good as assets. So, are any expenses you are incurring, or any sales you are doing, they are as good as your liabilities in the long term. So what we are saying is, if your purchases in the foreign currency are not offset with the sales, means you have purchased a raw material of so much from abroad, but you have not sold enough in abroad. Probably for a typical Indian company, raw materials it is importing, whereas sales it is doing locally. It is importing the raw material from abroad, assembling the product in India, and it is selling in India. It is exposed so much to foreign exchange risk, right? Because its raw materials, they are very much exposed to foreign exchange risk. But because the sales is in domestic, you may have to fix the price of the sales. So it may so be possible that the sales revenue price is not changing, but the cost of the raw materials is changing because of the exchange rate. And if it is going against your case, even you will end up into a loss. But you look at it the other side, you are taking the raw materials from US, assembling it. Assume that you are selling back the product to US, right? Your foreign exchange fluctuation is very much, the risk which you are facing because of the forex fluctuation is very much minimized. If your raw material price goes up, even your final sales price also will go up. So the kind of loss you are getting is pretty much minimized. So you have to make sure that the combination of the assets plus purchases in the foreign currency should be neutralized with liabilities and sales in the foreign currency. That is where we talk about the net exposure. Two aspects. One is whatever the properties, and probably the best way to talk about your current account and capital account. From a country's point of view, if I am looking at it, this is working more from those lines. Look at it in a slightly micro company level kind of a perspective. In a foreign currency, assets versus liabilities. What I am holding, what I have borrowed. In foreign currency, that is more in line with your capital account. Whereas the others, purchases and sales, which is like imports and exports. If I am looking at it from one single company's standpoint, even that is an exposure to your foreign currency. If these two are not balanced properly, you are having a potential exposure in a foreign currency, right? Now, One way to look at it is always match these two things. If that's the case, then probably there is no job for a risk manager, right? Probably if I borrow 50 million in US market and lend 50 million in the US market, what is the benefit I am getting there? Right? Or probably if I import 50 million and again export 50 million, what is the benefit that I am getting there? So that's a scenario where there is a zero risk kind of stuff. You are least bothered about the fluctuation in the foreign currency. If your assets match with liabilities always, but in real world, those things may not